He did not invent any drugs. He did not fund any research. He bought existing medications and raised the prices by hundreds of percent overnight. One drug rose by 5,000%. People who needed it had no choice but to pay. Wall Street called him a genius. This is Valeant Pharmaceuticals. He did not invent new drugs and he did not fund research and he did not employ scientists working toward cures and he had a different model. He bought drug companies, acquired their existing medications, slashed the research budgets, fired the scientists, cut every cost he could find, and then raised the prices of the drugs he now owned, sometimes by hundreds of percent overnight, and the people who needed those drugs to survive had no choice but to pay or go without, and for several years Wall Street called him a genius and the share price of Valeant Pharmaceuticals rose from $12 to $260 and hedge funds and institutional investors poured money in and then the model collapsed and the fraud at the center of it was revealed and the share price fell 90% and the patients who had been paying the raised prices were still paying them and the lesson of Valeant is that a business model built on extracting value from people who have no alternative is not a sustainable strategy, it is a moral failure disguised as financial innovation. Michael Pearson joined Valeant Pharmaceuticals as CEO in 2008 after a long career at McKinsey & Company where he had specialized in advising pharmaceutical companies and his philosophy was explicit and deliberate. He believed that the pharmaceutical industry spent too much on research and development relative to the returns that research generated, that most drug research failed and the successful drugs were not valuable enough to justify the enormous investment, and he believed that a better model was to acquire companies with existing proven drugs, eliminate the research costs, and extract maximum value from the existing product portfolio. This philosophy required raising prices and Valeant became notorious for its price increases, acquiring a drug called Nitropress used in cardiac emergencies and raising its price by 212% overnight, acquiring Isoprel another cardiac medication and raising its price by 525%, acquiring Cupramine a drug used to treat Wilson's disease and raising its price by over 5,000%. And these were not isolated incidents, they were the systematic application of a strategy that Pearson implemented across hundreds of drugs, the identification of medications with limited generic competition where patients had no alternative and the extraction of maximum revenue from their desperation. The strategy worked financially for several years and Valeant also grew through acquisitions, buying Bosch and Lohm the eye care company and Salix Pharmaceuticals and dozens of others, financing these acquisitions with debt and using accounting practices that Valeant claimed were legitimate but which critics argued obscured the true cost and sustainability of the business model, and the share price rose and investors who questioned the model were dismissed and short sellers who bet against the company were publicly attacked by management. The first major crack came in 2015 when Valeant's relationship with a specialty pharmacy called Philidor RX was exposed by investigative journalists and by short seller Andrew Left of Citron Research, and Philidor was a captive pharmacy that Valeant had secretly established and controlled, a pharmacy that existed primarily to channel Valeant drug prescriptions away from pharmacies that would seek lower prices or substitute generics, and the relationship had not been disclosed to investors and the revenue Valeant was recording from Philidor was being recognized in ways that investigators subsequently challenged. When the Philidor relationship was revealed, the share price began to fall, and then in late 2015 and early 2016 additional problems emerged. Questions about whether Valeant had been booking revenue from Philidor in ways that inflated its reported sales figures, questions about the accuracy of financial statements that had been presented to investors, and congressional investigations into drug pricing that placed Valeant and Pearson directly in the spotlight of public and political anger. Pearson was called before a Senate subcommittee hearing on drug pricing in April 2016 alongside former hedge fund manager Martin Shkreli, who had himself become a symbol of pharmaceutical price gouging after acquiring a drug called Daraprim and raising its price by over 5,000%, and the hearing was one of the most contentious pharmaceutical industry confrontations in congressional history. In Pearson's testimony did nothing to repair Valeant's reputation and everything to confirm the public's understanding of what the company had been doing. Pearson was replaced as CEO in May 2016 by Joseph Papa, and the new management spent years working to address the debt, which had risen to approximately $30 billion through the acquisition spree, and to stabilize the business, and the company was eventually renamed Bosch Health Companies in 2018 in an attempt to separate itself from the Valeant brand, which had become synonymous with pharmaceutical price gouging. William Ackman, the hedge fund manager at Pershing Square Capital Management, who had been one of Valeant's most prominent and enthusiastic investors, suffered losses of approximately $4 billion on his Valeant position, and it became one of the most significant investment losses of his career. And Ackman's public support for Valeant's business model His presentations to investors arguing that the stock was significantly undervalued contributed to significant additional investor losses in the period before the collapse. Michael Pearson was not criminally charged in relation to Valeant's business practices, and a securities class action lawsuit against Valeant was settled for approximately $1.2 billion in 2020 without the company admitting wrongdoing. So what is the real lesson of Valeant Pharmaceuticals? And the lesson operates on two levels, and the first is about the specific harm. Valeant demonstrated that it is possible to build a business model on the vulnerability of sick people, on the fact that patients who need a medication to survive or to manage a chronic condition have no meaningful ability to refuse to pay whatever price is charged. And this is not a market in the traditional sense. Markets require some ability for buyers to decline. When the buyer's alternative is death or suffering, the price mechanism fails as an allocative tool, and what replaces it is simply the extraction of whatever the buyer can pay. And the second level is about the investors and institutions who celebrated and funded this model, who called Pearson a genius and drove the share price to $260, because they were not passive observers of the harm. They were funding it and profiting from it, and their enthusiasm was a necessary condition for the continuation of the practices. That is the capital case. Subscribe to the capital case because the next case is already waiting.